I'm going to review drawdown fund fees and terms. We're going to go through a management fee problem and a waterfall distribution problem. A hedge fund manager raises $100 million in committed capital for his fund. The management fee is 2.5% annually. To date, only $50 million of the raised capital has been called and invested in stocks. What would be the annual management fee? This is a very simple problem. We're going to use the committed capital, not the invested capital. And that is 100 million times 2.5%, which comes out to $2.5 million per year for the management. Now onto the waterfall distribution problem. Assume a $200 million contribution by the LPs in the first year to fund an investment, a 6% hurdle rate, a 100% catch-up rate, an 80-20 split on carried interest, and the sale of the investment by the fund in the third year for $300 million. Determine the total cash flows to the LPs and the GPs. To do this, I made a table to lay out easily each line item and each cash flow to both the LP and the GP. First, we have return of the principal, which is the invested capital, or the committed capital, you could say, to the LPs, which is $200 million that they initially invested, and that goes back to them. Then we have the preferred return of $24 million, which is calculated by 6%, which is the hurdle rate, times 2 years, which is the time the investment was held by the management, times the invested capital of $200 million. This comes out to $24 million, as you can see right here. And that is the preferred return or hurdle rate that the investors require before the GP can receive any incentive fee. Now we can move on to the incentive fee, and the catch-up rate for the GP here is 100%. To calculate the incentive fee for the GP, we can do $24 million, multiply that by 20%, which is their split on the carried interest, and divide the $24 million times 20% by 1 minus 20%. This comes out to $6 million, and this is the general partner's initial incentive fee on the initial preferred return. The total of the preferred return and catch-up for the GP is $30 million. We can subtract that from the total profit of $100 million, which is 300 minus 200, and we get $70 million for the GP and LP to split. So the 80-20 split, you just do 20% times 70, which comes out to $14 million. And the 80% that the limited partners get is $56 million. So the total profit is $100 million, 300 minus 200. 20 of that goes to the general partners for their services. $80 million goes to the limited partners for their investment.